Here is a mathematical impossibility happening right now inside our modern United States housing market. We are posting the absolute lowest number of home transactions since 1995 today. Yet somehow, at this exact same time, home prices remain near their absolute record highs. Normally, fewer active buyers and higher home prices would cancel each other out completely everywhere. But our current real estate market is completely frozen, while prices remain entirely absurd everywhere. The average first-time home buyer is now 40 years old, which is completely unprecedented. If you have tried buying recently, you already know something feels deeply and structurally wrong. Welcome back to Pete Invests, where we explain exactly what broke our modern housing market. We are going to look closely at every actual number so you can prepare wisely. The median existing home price across America right now is $418,000. 7 years ago, that exact same median home cost only $272,000. That represents a massive 46% total jump across the middle of the country. Right now, average mortgage interest rates are sitting firmly around 6.5% nationally. That sounds manageable until you remember the amazingly low rates from just 3 years ago. Back in early 2021, you could get fixed mortgages under 3% easily. That massive percentage difference places regular home buyers on a completely different financial planet today. Let us examine what that huge gap actually means in real out-of-pocket dollars. Imagine buying the exact same house with 20% down and a standard fixed mortgage. At that old rate, your monthly mortgage payment was only $1,293. At current higher rates, that exact same loan costs over $2,000 every month. You are paying over $700 more every single month for 30 long years. You get the exact same house with the same carpet and the same school district, but the physical house itself costs $146,000 more today, everywhere. You are effectively paying significantly more for the bank loan and the house both simultaneously. This nightmare situation is clearly not bad luck for average working-class American homebuyers. It is the direct output of specific financial decisions and massive global economic system shocks. Once you understand this sequence, the current housing situation feels like an absolutely inevitable outcome. The year was 2020, and the entire global economy was metaphorically catching on fire. The Federal Reserve panicked and slashed interest rates down to zero in an absolute emergency. They started injecting massive amounts of cheap money directly into our vulnerable global financial system. By early 2021, the standard fixed mortgage hit a historic, absolute rock bottom. People who were waiting suddenly realized they could afford dramatically more residential house living space. So regular consumers confidently went out and bought massive amounts of real estate very quickly. But extremely cheap loans were only half of the fuel for this real estate bonfire. The global pandemic completely rewired what everyday American citizens strongly needed from their primary homes. Suddenly, your small city apartment was your busy office, your gym, and your safe space. Millions of remote workers suddenly realized they no longer needed to live in expensive cities. They left expensive coastal areas and rapidly moved out to places with far more space. Cities like Austin and Phoenix suddenly saw a massive stampede of eager new remote buyers. National home prices jumped 37% in just 2 short, extremely chaotic market years. Thousands of normal homes suddenly sold for $100,000 over the asking price. If you bought back then, you probably made an incredibly brilliant financial decision by accident. But for absolutely everyone else, what happened next made the entire market situation dramatically worse. By mid-2022, total national inflation was running at absolute record-breaking highs. so the Federal Reserve aggressively raised interest rates faster than they had in 4 decades. Mortgage rates, unfortunately, followed this exact same trend directly into the worst possible upward direction. By late 2023, interest rates hit their absolute highest peak since the millennium. To buy a median-priced home today, you must earn $106,000. Meanwhile, the median American household income is only sitting right around $83,000. The average American family is mathematically short of qualifying for a perfectly average normal house. Rising rates pushed millions of regular buyers completely out of the active real estate market. Home sales fell dramatically, marking the absolute slowest 3-year stretch since the mid-90s. But here's the insane part that should genuinely break your entire rational economic brain. Property prices absolutely did not fall when all the desperate new buyers left the market. Demand collapsed rapidly, but available housing supply completely collapsed at the exact same time, too. This rare economic phenomenon created something the modern real estate market had never truly seen before. The entire real estate system went into a total freeze that quietly holds everyone hostage. Right now, half of all American mortgages carry a wonderfully low sub-4% rate. If you currently hold one of those cheap loans, you possess a rare financial instrument. Selling your current house means voluntarily surrendering the cheapest borrowed money you will ever access. Replacing that amazing cheap loan with an expensive new one costs thousands of extra dollars. Because of this massive financial penalty, rational homeowners are simply refusing to sell their houses. This stubborn effect has successfully suppressed millions of real estate transactions that usually happen. Active housing inventory remains significantly below normal levels required for a healthy, balanced housing market. The market is completely broken because it has entirely stopped moving in any meaningful direction. It is stuck tightly like a broken wooden door that firmly refuses to open correctly. Normal, hard-working professionals with good savings and great credit simply cannot afford typical homes. Housing costs would easily consume far too much of their monthly take-home salary today. This painful reality is not a personal failing, but a deeply structural mathematical market problem. First-time homebuyers currently make up a severely depressing record-low purchase transaction share. Wealthy, older generations are largely buying these overpriced homes using fully available heavy cash reserves. Younger, aspiring owners are aggressively delaying major life milestones because they cannot afford buying property. Many hard-working millennials have completely given up on the classic American dream of ownership. The basic defining marker of middle-class stability has been pushed far into middle age. Meanwhile, major financial institutions will always falsely claim that today is a perfect buying time. But the tragic housing shortage was secretly assembled over 15 years of severe historical underbuilding. Following the big crash, timid corporate builders pulled back hard and constructed far fewer homes. They heavily focused on building expensive luxury properties because that is where profit margins thrive. Small starter homes for regular people were essentially discontinued entirely as a profitable consumer product. Then, massive inflation hit the building supply chain, making new construction even more wildly expensive. This painful supply issue took 10 full years to create and requires decades to fix. Worried people always want to ask if this current market is secretly 2008. The simple and honest answer is absolutely no, because the modern structural reasons are different. Back then, greedy, corrupt banks aggressively loaned out terrible mortgages to completely unqualified, desperate buyers. Today, modern lending practices are incredibly sound, and most current borrowers are actually highly qualified. Homeowner equity is very real, yet you still cannot afford to buy anything decent today. This is fundamentally a frozen, deeply expensive, structurally constrained market instead of a fragile one. We are all waiting patiently for mortgage rates to naturally drop back down to reality. But a sudden and dramatic rate drop might temporarily make the entire affordability crisis worse. If rates fall quickly, millions of waiting buyers will violently flood back into the market. That sudden, massive wave of intense demand hitting low supply will simply force prices higher. The most realistic and honest forecast is a very slow and mostly boring multi-year correction. We will likely see home prices move sideways while average worker incomes gradually catch up. You must make big financial decisions strictly based on your actual numbers and true budget. Renting a home while aggressively investing your leftover money is a completely brilliant financial strategy. Ignore the endless noise, properly run your numbers, and carefully protect your hard-earned wealth. Always prioritize careful math over the endless greedy hype pushed by mainstream financial media outlets. Thank you so much for watching this detailed Pete Invests financial housing market breakdown today. Please make sure to carefully like this video and officially subscribe to our growing channel. Finally, turn on the notification bell so you never miss another important market update again.